Welcome everyone to the FP Markets a global look at the markets, not so much a look at the global markets, but a global look at the markets, a wider view look at the markets. It is very difficult, as you know, to predict where things are going to go in this age of volatility, and I don't think I've seen a research analyst yet put forward his idea with the statistics to back it up. So we're coming at it from a different approach. We're going to look at a number of key drivers in the global markets, and particularly related to Australia, and really we can work out our own picture. So hopefully tonight I can give you some tools to look at that you can take forward at any time and really come up with your own view of the world, which is most important, that we have our own view of the world. A little bit of background about myself for those who don't know me. I hold the Australian Diploma in Technical Analysis. This was later went on with the Certified Financial Technical Analyst with IFTA, the International Federation, in 2004. I spent a few years on the desk with Macquarie and RBS and Wilson. A lot of years private trading, hold ADA 1 and 2 derivatives accreditation, a member of the Australian Professional Technical Analysts Association, which is APTA, and I'm also president of the Sydney Australian Technical Analysts Association itself. So a bit of a background in analysis. This material contains information from external sources and intended for education and general information only. It does not constitute financial advice. It does not take into account your investment objectives, financial situation, or particular needs. So what that's saying is, before you act on anything you might see or hear, you must consult a licensed advisor. So always, trading and investing is a business. Mostly people come to it and think that they can make a bit of spare money in their spare time, and without any regard to the amount of effort and work that's actually required to consistently take the winning side in the market. So we treat it like a business, and it is not a hobby at all. One of the issues, as everyone is aware of around the world at the moment, is money printing. This has led to zero and sometimes negative interest rate outcomes, and has allowed many businesses to remain in business, leading to an oversupply of everything. And that broad statement says that if you go into any supermarket, any warehouse, any hardware chain, most of the goods are manufactured overseas cheaply and sitting on our shelves. It provides no room for us to manufacture anything other than small cap industries. So coupled with the fact that our shelves are filled with cheap goods, essentially the world ex-China has been manufactured out of business. We can buy anything we want online, and we're manufactured out of business, and we have several choices to go to buy something. The largest single issue, global issue at the moment is still, and another one came up today which didn't make it into my slide, but the largest single issue at the moment, and you'll see a lot of this in the media, is Europe's banking system. Essentially the statements say that it needs 150 billion euro to bail it out, to stave it off collapse. Now this is not the IMF saying this is not the World Bank saying this is the bankers themselves saying this. And as they have copped a bit of criticism in the past, they're always the first to hold their hand out and ask for money. So the issue around the globe at the moment, and there's a lot of press about it, is Deutsche Bank being the central bank that has a lot of relationship banking around the world, is a little bit interesting what's going on in the background. Is it too big to fail? Probably. Before we get going, as always, we're going to take a look at the markets and ask the markets what they're telling us, rather than guess where the market's going to be or what the market's going to do. It's far better to look at the market and say, well, you know, what can I see in here? What is this actually telling me? And one way of doing that, the most profound way of doing that is with trend analysis. Now, simple trend analysis has a situation where prices simply move up, they make a high, they pull back a little bit or a lot and make a higher low compared to the previous low, and then eventually break through that high, and you have, at that moment, you have a trend in place. Now, we refer to it as a primary trend when it is out in large time frames. When it's in weekly, monthly charts, it is referred to as a primary move of the market. This application also applies down into intra time frames, daily and less. So an uptrend is defined when something breaks pulls back and then moves up and breaks a previous high, and after that there's really expectation that it may continue and it may not. A downtrend is defined exactly the opposite way, where the market moves up, makes a high, makes a lower high at some point from a higher low in here. Let me get my little pen out. I can makes a higher low in here, and then market rallies up, makes a lower high from previous high, falls down, comes down and breaks the previous low. At that exact point in there, you have a downtrend in place. There is no other methodology for trend analysis except this, and what I want to do tonight is look at some global aspects in looking through the lens of trend, see where we're going and do we have evidence of something else. So the start of a primary downtrend is identified when the price makes a new lower low after making a lower high. Very simple statement. It applies in all time frames. It is considered a primary trend when it is out in large time frames. This is one of the single biggest issues in the world at the moment is Deutsche Bank. Their share price used to be over $90 and currently sits just above $10. It has not recovered out of the GFC from 2009, the lows in 2009, and is essentially testing those lows. We can see all the way through here essentially primary downtrend in the stock. This is what's got everyone a little worried. And the second statement from the same economist inside Deutsche Bank said that Europe is extremely sick and must start dealing with its problems extremely quickly, or else there may be an accident. He said, "I'm no doomsday prophet, but I'm a realist." Well, what he's trying to do is essentially bring the attention to the banks in a little bit of trouble from their side, and they'd like a bit of a hand. Whether that occurs or not remains to be seen. The trend in this particular stock is down and sitting here just over $10. It's about to break the GFC low. If we had the same situation in Australia, it would be very similar to Commonwealth Bank, essentially falling out as it did in the GFC, as everyone else did, and Commonwealth Bank since recovered. But if Commonwealth Bank today was trading at just over $12, you can imagine the concern around that. The second biggest issue in Europe is Italy. Recovery would be derailed by Italy's teetering banks, which are sitting on a euro 350 billion of bad debt. Their share price has been happening since weeks. The largest bank in Italy is UniCredit. It also had lofty highs prior to the GFC out here over $40 and has not recovered out of the GFC and currently sits here at around about $2 down here. So $2 out of 40 is where the bank's value is. So it recently lost another 30%, which is just down in this little area here. It's not hard to do when you get into small dollar amounts to lose 30% out of the Brexit situation. Which brings me to this, which is Lloyds. Now this is the Lloyds price on the New York Exchange. Lloyds has been in just a couple of years of data on this back to 2014. We saw in here market had moved up in late 2014, early 2015. Since then broke trend and has set a series of lower highs and lower lows. Broke into a short move here on one candle, basically a fake out, and then simply reversed. Now this this guy here, very large range in here. This is the Brexit vote on this stock. This is a weekly chart. We can see since then that the stock has fallen, gap down, and there is a hammer in the bottom of the chart here with currently this week so far it has gapped up on this side. So it does at this point in time there is a pivot in place, a pivot point reversal in place, but essentially the trend on this thing is still well and truly down overall. So what we need now is a line in the sand, if you like, which I'll come to in a moment, that this needs to continually trade out through here to gain any sort of respectability back. If there is a break of the low here at around $2.50, it's game on for lower prices. One of the other aspects of the Brexit fallout will be Wesfarmers. Wesfarmers, as you know, recently purchased a UK hardware chain. Currently, Wesfarmers has been trading sideways for a number of years, and today was lower today. It has, what I'm going to do in this presentation is offer a set of boundaries, if you like, that need to be monitored, and you will then see where things are going to go on your own hand. So here, Westpac, we can see up here the breakup point would be $44, which is essentially a break over this high. Would be very, very interesting. It would certainly come onto my radar, and a breakdown point on Wesfarmers is back here on this $39 area, this closing price area down here. So if we saw this stock break down, would not be a great look in here. We already have a lower high here from the previous high, and a potential lower high here again. So essentially entering into a further downtrend. Now it's contained within this range. I can see that, but it's really not, as today we had a fairly good day in the market. Wesfarmers wasn't part of that. An interesting outcome. The pound against the US dollar, as everyone knows, there's been lots of fallout over this. In the last couple of weeks, lots of reports coming out suggesting it could go to 120, could go here, could go there, blah, blah, blah. It could go anywhere. There is a very interesting technical aspect in this bar here, in as much as it is an outside range. It has a larger range than the here than the previous week, in here. And so the mantra for an outside range with a down close like this, it will mark the low within 1 to 3 bars, at or within 1 to 3 bars. So here we have one further lower low, one further lower low, and currently we have a higher low in here. So the breakup key reversal on the pound, it needs to trade over 135.36 to be considered anywhere near coming off these lows. A breakdown point on the British pound will be 1.28, which is essentially these lows in here. We'll suggest then that the pound may head into a target of 1.14, which is the 1985 closing price, the support price, and below that is a number 1.05, which was the low in 1985. We can see quite clearly, long before the Brexit vote came along, this trend is down. Lower highs in the big picture, lower highs, lower lows, and recently a new low down here after breaking this low right here. These large periods take a lot of effort to get past on the other side, and this needs to do a lot of work in here to regain its composure. The look around the global markets from an economic point of view, there's some interesting numbers come out. Some are very similar. What's really interesting at the moment is the basically around the westernized countries ex-China is the rate of GDP, which currently in the United States, the current GDP is around a bit over 2%. They call it a booming economy at 2%. Well, I don't know what China is at 6 and 7%, but the US refer to themselves as a booming economy at 2%. The Euro area is around 1.7% GDP growth. When you look through the figures on these Western countries, we can see that the US jobless rate here is around 4.9%. Anything under 5% is considered full employment. The Euro area has 10% unemployment. China has 4% unemployment. What's also interesting, which seems to have missed the media because it's not newsworthy apparently, is the debt to GDP in the US, which used to be almost 120%. Is currently sitting here at 104%. It's actually falling because their GDP is slowly growing. And in China it sits here at around 43%. So the Euro area also went to, I think, just under 100% about a year ago, and is now currently sitting down here at 90%. So this GDP growth on this side is certainly adding at reducing this number here on the right hand side. So a very simple, fairly simplistic observation of that, but it's an important one. If it was so important at the high price, then it's got to be important at the low price. Also, what stood out in the numbers was the actual household debt to GDP. So the on the street debt, if you like, to the GDP of the country. In the US, about 79% of household debt to GDP. In the Euro area it runs at about 60%, and in China around about 40%, which is the accumulated private debt compared to the GDP. A little scary is this: when we bring Australia into the picture, we have fairly good GDP growth rate at 3.1%. Our inflation rate is pretty much the same here as in China, as in the US. In their Euro area has very little inflation, and the jobless rate here at 5.7 is in that 5% area and would be considered almost full employment. Debt to GDP from a government level is 36%, which is quite low in the Western world. What's quite scary is the household debt to GDP, which currently runs at 124% of GDP. It is about $1.7 trillion. The Australian GDP at the moment is $1.3 trillion. You can see that in here. And the current debt is 124% of that in numbers. It's great for companies like Credit Corp. If we saw an interest rate rise in this country, this would come under severe pressure, this debt problem. So great for companies like CCP. I would keep an eye on their share price if anything went untoward. So the 101 of economics of supply suggests that lower prices are achieved, or deflation in prices come from oversupply. This is essentially the mantra behind economics. The current policies being deployed to try and incite inflation is really giving us a deflationary outcome. The current lowering of interest rates has only allowed poorly run businesses to stay in business. And we've seen this in the oil industry in particular, where the rig counts were up at 800 and 900 rigs, and with the oversupply and the falling of oil price, that rig count fell quite dramatically, well under 300. At the same time, the consumer continues to purchase goods, so there's equity in the consumer real estate area, and they're using that leverage to purchase goods. So the supply of money around the world and these low interest rates in achieving that money is allowing for this oversupply, over-manufacturing of goods around the world, and the over-purchase of goods, and this is what's driven China, as everyone knows. Based on trend, this is the Australian interest rates back over 25 years. We can clearly see that the trend is down. It's not a recent phenomena that everyone's talking about interest rates being at 1.75%. They have essentially been trending down for a number of years with a series of lower highs and lower lows along the way. And currently here, I read a report yesterday suggesting that the interest rates may in Australia eventually head to 1% or less. The trend is certainly heading that way. There is no evidence that it will simply start to trend up in here. So the trend on Australian interest rates is down at the moment. So we're up against this line in the sand, essentially globally. We have global growth. The line in the sand, if that crosses the line in the sand, will be deflation in there. This is the real issue here. So the real driver is still GDP and inflation. Here, this is the real driver. There's a question here, why is Australia's credit rating being challenged lately when the debt to GDP ratio is relatively low? It is because the Australian government has not got it under control, and it is actually growing. It used to, you remember some years ago, it used to be zero, essentially, and now it's 36%. It used to be 24% a couple of years ago. It's going in the wrong direction. So when we look at GDP growth rates, the actual advancement of growth, we can see when you lay it out on a chart like this, this is essentially over 10 years of data. The US GDP growth rate has been essentially flat through here, zigzagging around 2%. It is not growing year on year. It needs to grow year on year. The US government bond yield down here has fallen well under 2% now at about 1.36%, I think it is at the moment. It is trending down. There are a series of lower highs and lower lows in here, and potentially another lower low coming in here. This is trending down. This is going sideways. The European GDP growth rate paints a very similar picture here. What's a little interesting about this is that it has taken a dip through here and is starting to move up, and if it takes out this high, this 2 and a bit % high in here, we should see some interesting press come out regarding that. But we look at the Stability Fund bond yield, we can see that it crossed zero late 2015 and is heading in here towards 0.5% negative interest rates. It has also set a series of lower highs and lower lows along the way, and there is nothing in this chart that suggests anything else except lower highs and lower lows. The Australian GDP growth rate, again, also over the last 5 years, has essentially also moved sideways around this 2.75 average through here. What is interesting about this is we do have a higher low here and a potential higher high coming through here. This will be good. The Australian government bond yield, 10-year bond yield, is heading downhill. We can see that in interest rates currently at 2%, just a bit under 2% here. They dipped under 2%, I think, just last week, the 10-year yield. A futures contract is a standardized forward contract which can be easily traded between parties other than the two initial parties to the contract. The parties initially agree to buy and sell an asset for a price agreed upon today, the forward price, with delivery and payment occurring at a future point, the delivery date. Because it is a function of an underlying asset, futures contract is a derivative product. Futures contracts are negotiated at a futures exchange, which act as a marketplace between buyers and sellers. Essentially, both parties risk their counterparty walking away. If the price goes against them, the contract will involve both parties lodging a margin of the value of the contract with a mutually trusted party, which is usually the broker. So we start to unwind this now and start to look into the futures market, look into around what really drives the world at the moment. And if anything is going to rescue the world, then we need to be looking in these areas, because this is the markets have an incredible ability to look forward, and we saw You can see that in the British pound, you can see that in the London stocks just before Brexit. They seem to be trending down and then just simply collapsed on the Brexit. Market has an incredible ability to look forward if you look into the market and ask the market what's going on here. This is a candlestick chart of copper. There's three elements on here that we need to take notice of. Currently, copper's trading around here, around about $2.20 a pound. It has been trading sideways, broke down here. This is about a 5-year chart in here. It broke down here, just here recently, came in, found a low. It broke below $2, found buying very, very quickly and rallied up to test this breakdown level and has since then formed a higher low here and a lower low here. The stock, the copper contract, if you like, is in a sideways trend through here. This is really interesting as the RSI indicator is moving up and is currently sitting over 50. Now this is not divergence here, it's just stating that the RSI is moving up and is over 50 is actually a good outcome with this. We've seen the RSI in the background simply move around with the trend itself. But here we have essentially the stock price, or the contract price I should say, moving sideways, but the RSI is moving up, suggesting that there's strength in there. The other interesting area down here is the amount of interest in here has grown dramatically. The breakup level on copper is now $2.32. If copper trades over and closes over $2.32, it's going to get very, very interesting. This type of pattern, this type of long base pattern here, is a very, very strong signal that there is a base in this commodity. This will be proven wrong if the breakdown at a breakdown level of $2. So if we get a closing price again below $2 a pound, this will be proven wrong and simply a rest period before heading lower. At this point, with the RSI moving up as it is, it suggests strength in this particular contract. In the nickel market, it is showing a very similar pattern, except in nickel we've actually got the breakout here on the right hand side. So between late 2015 and currently, we have this long flat sideways pattern in here. We've had the false break. You'll see this in most commodities charts, most equities charts. You'll see this break down here, which was early this year, 2016. The break up level on nickel is at $10,000 a ton. The breakdown level is $8,100 a ton. These numbers are reported every day in our morning newsletter, what that current number is. So what's interesting here is the nickel chart is making new highs, a new higher low I should say, and new highs out through here. It is a very different picture than what's occurring on the left. Stocks involved around the nickel market, of course, are S32, Rio, Western Areas, Poseidon, I think it is, and Dragon Resources, DRA, are the stocks involved around this particular commodity. If you have a look at Western Areas today, it was up 12%. Aluminium shows a very similar picture as well. The aluminium contract here made lows late 2015 and early 2016 and is starting to trend higher. It has broken out through here and set a higher low than the previous low. The break up level on this commodity is 1,680 and the breakdown level is 1,520, which is essentially in this area somewhere in here. If we get a break below there, then it would suggest that we may head lower. Stocks involved in the aluminium industry, of course, are Rio, S32 and AWC. Coal. There was a lot of press about coal around the world. As you know, funds getting out of the coal industry, becoming a despised commodity, if you like. The problem with that sort of thinking is that currently in the world the global markets, the global steel industry, they manufacture 1.9 billion tonnes of steel per year around the world throughout all the steel manufacturers in China and India and around the world, the US and Russia. And it requires 1 tonne of coking coal to produce 1 tonne of steel. The coal industry is not going to go away. The coal chart has a very similar pattern through here, has the low in early 2016, has a long, slow, sideways pattern. I'm sure this is a bit of a data error, I should say. It has set a high in here, it has set a higher low, it has broken out through here at $55 and is heading up towards $60 in there. The breakout level on this is $62, which is this past resistance at the moment. So this area here at $62. The breakdown level is $53 down below, just at this low through here at 53. That's that one right there. Stocks involved in the coal industry, of course, are Rio BHP, Whitehaven and Yancoal in there. So a very, very interesting place at the moment that simply won't go away. And just to lighten it up, of course, coffee. This could be the beginning of global inflation. Coffee also has a very long low base in here through 2015 and 2016. Coffee broke its resistance highs here just a few weeks ago, came back and tested them here, higher low again, higher low and previous higher lows, and coffee is moving out here at $150. The further breakout, so I've got the further breakout level here at $150. It needs to continue over that area. The breakdown level will be around here at $140. Just yesterday there was a news item out that said customers at many Starbucks US stores will pay as much as 30 cents more for certain beverages as prices for raw coffee have climbed amid rising operating expenses. It also was reported tonight on Bloomberg that coffee in the UK will now become more expensive based on this commodity starting to move. This could be the beginning of global inflation. Iron ore, of course, what interests Australia at the moment, this hasn't really broken into a trend just yet. I'd like it to see it break over this area here. The breakup level on iron ore is $62. The breakdown level on iron ore is 53. It's currently trading at around, I think around a bit over 54, just under $55 from last report. In their stocks involved with the iron ore industry are Rio BHP, not Whitehaven, it shouldn't be Whitehaven, it should be Fortescue and Atlas Iron. So the iron contract, a very strong psychological area. We can see a lot of action around this $50 mark. So important in the iron ore contract, iron ore prices around this $50 area. Interestingly enough, on the tradingeconomics.com site, which is a wonderful site for picking up basically global information, they run a fairly sophisticated forecasting tool on there, and they have iron ore forecast essentially the way they research analysts, they research prices, they do the whole thing, and essentially they're suggesting that the only way for iron ore at the moment is up here within a band between around about $68 and $45 a ton. So the breakup level on this particular application is 67 and 47 on the downside. And there we go, Rio BHP, Atlas and Fortescue involved with that. All right, I'll leave that there for a minute. The question is, why does coffee signal inflation? Because I buy a cup of coffee every day and I'll probably end up paying more for it, so it's inflation. Okay, so I want to now look at a couple of charts. Here. Number of people ask me what platforms I use. This is a Reuters platform, and in a moment I'll bring in a platform called Phoenix AI. The FTSE, the current daily chart of the FTSE shows the indecision here leading into Brexit. This movement down most probably a pole, movement up was most probably a pole, and the significant movement down here that broke the previous low was the Brexit outcome itself. What's fascinating about this is it's had a significant move up in here out of this volatility. Now, just want to sort of point out that there's a fairly aggressive series in here, and I'll come back to this in a moment, but this very aggressive pattern has led in sorts to this very sharp rise up through here. Comes out of this widening wave in here as volatility swings wider and wider, and you end up with this type of movement in here. So currently the FTSE around 6,700. If we take a look at this on a weekly basis, which is always best to do, we can see, I'll just get those off there. Whoops. Okay, lost it. Bear with me. Okay, there we go. So on a weekly, not weekly, come on. Sorry, on a weekly basis, we can see this is where we're going to see this pattern on a number of charts at the moment. It is fascinating how this is turning out. The FTSE came out of 7,000 points, did a downtrend down through here. What needs to be monitored here is there are three significant lows in this chart. There's a low here in August, September 2015, a low in February, which is in most indexes around the world, and a low here recently on the Brexit move. This is three major lows, three spike lows in here is starting to look a little bullish on this at this stage. So this breakout here does need to continue, does need to pull back and start to trend, and we would be looking at a new trend in the FTSE itself. The other one I wanted to look at was the DAX. This is, you can see a very similar pattern here, the lows here, August, September, the low in February, and the recent low in June, July, but we certainly do not have the amount of bullishness here that we've seen in the FTSE itself. The DAX is up against it right here at 10,200 points. It is nice that it has these three shadows in the background here, but essentially this is trending down, high, low, lower high, lower low, currently a lower high, maybe a higher low, so the break point on this is certainly going to be over this certainly to 10,200 on the trend line, and 10,400 up through here. It needs to be taken out. So we're sitting right here currently just under 10,000 points. So an interesting place for the DAX. Now I'm going to change my software again so we can look at a few other things. This little thing is called Phoenix AI. I want to focus on the weekly charts here. Whoops. Focus on the weekly chart. We take a look at the Dow Jones Industrial Average. In here, this also, let me bring this up. The Dow Jones also has three significant lows in place again, and as everyone's aware, it broke to the high side into record territory last night and may continue tonight. What the concern is, this Brexit, very large range here on the Brexit vote, and shorter range the week after that, and a shorter range so far this week. There is concern, and I'll show you why that is in a moment. This ultimate high out through here, ultimate high out through there, we've seen it just pip that. Now it certainly may break over that. It has the hallmarks of a higher low in here and may certainly break over that area. I'll also just bring in the S&P 500. The S&P 500 has done pretty much the same thing. It's a little ahead of the Dow, and as far as its range, it really has broken out across its previous high set back here in May 2015. And you take a look at the volatility on this, the volatility ranges. Again, it has three significant lows in here, and this low here much higher than the previous one, and the break here. So it is certainly trending up. The very big concern that I have with these markets is this chart. That's not the chart I want, is this chart. This is the Dow Transports. Someone's asked me 18,300 at the current level, what do you think about its future? If you listen very carefully, you can actually work this out yourself. This is the Dow Transports. There is a theory around a theory called Dow theory, which I subscribe to rather fervently. Says that before you have a bull market in place, you must have the transports and the industrials confirming each other in trend. And the same with the bear market. If a bear market is to be declared, it says that the industrials and the transports must both confirm the same trend. The averages must confirm. This is the transports index. It is way below its all-time high out here in November 2014. The message when the Dow broke down in 2015 was the transports had already made a lower high through here, and the Dow and the transports moved down together. What's concerning myself as an analyst is that the transports here on the right-hand edge have not kept up with the Dow in recovering to their highs. A lot of people say the transports don't matter. They do matter, because the transports are centered around the global movement of commodities, the global movement of manufactured goods, and the global movement of agriculture. And no matter, you buy your goods at the supermarket, they get there somehow. You buy your goods online, they get delivered somehow from the commodity to the manufacturer to you. And this is not pointing in the right, this is not suggesting strength in this particular area at the moment, which is on the consumer side of the market, and it really backs up why these GDP figures are seemingly quite low. So it's not showing up in the transports at the moment. The key issue with this is that one of these averages is going to catch up with the other one. The Dow is going to come back to the transports, or the transports is going to advance to the Dow. So that, because over 100 years of history, that tells us so, that they will eventually catch up to each other. When the transports broke down here in May 2015, which was really in here, the Dow had made a new high and the transports were going in the opposite direction, and ended up, and I'll bring back the Dow at the moment, and ended up, this was the high in 2015, and ended up, the transports had already made their high and were heading down. The Dow was heading up, and eventually the Dow had this corrective move in August 2015. So I'm not suggesting the Dow is going to correct, not for a second, but I am saying that these two averages need to complement each other in their movements. Could the transports be less important because of a higher proportion of services in the GDP? Possibly so. Possibly so. GDP mostly is built around cafes and baristas these days, particularly in Australia, my view. Apologies if you're a barista. But it's GDP, I think my view of GDP is it needs to be manufactured goods that leave a border ultimately. So yes, look, it could possibly be that, but there is a significant difference between the transports and the Dow at the moment. The other commodity that we need to look at, of course, is oil. Oil, a lot of talk around oil, also made the lows in February. We saw all through the commodity complex that we looked at, copper and nickel and iron ore and those sorts of things, all through those complexes, they made lows in February. Oil was one of those. It rallied into $50 here. Why $50 is important is this. I'll just draw a line across there. Around this $50, there's a lot of price action around $50. Big psychological area in oil around $50 a barrel. And we saw the retest here in August, September 2015. The contract fell away into the lows. It has rallied back to that previous resistance level and is simply consolidating under that line. So clearly the go-to levels for oil are a solid close over $50 and beyond. It is a subject to supply and demand, of course. Lots of things going on around that at the moment, particularly there are things to watch. Venezuela, their economy potentially is about to collapse. The Western African nations are in a little bit of turmoil and may not, their oil industry may also slow down. And it's not enough, the oil price is not high enough yet to really get those Canadian oil sands up into production. So there's also a lot of, as well as the current oversupply, this inventory supply, there's also a lot of potential risk in the oil industry that may push this back over this $50 mark and higher. This would certainly add to a little bit of inflation as well. I've only got a line chart of the oil chart. This is just a daily closing price. It's a little bit all over the place. What is a concern in the short term is it is below, the RSI here is below 50, but bouncing along, a nice close back over 50 would be nice with a higher close into here. Now this is a West Texas contract and around about 46 at the moment. So a higher close would be very, very interesting there. And the last one I want to look at is gold. The weekly chart of gold so far this week, a couple of things about the gold chart. Everyone's very excited about the gold chart. After this long, broad downtrend, back in November, December, just prior to the rest of the commodities doing a bit of a U-turn in there, is the gold produced this small rounding base here. So a strong corrective move out of the lows. A lot of people say that gold is a hedge against inflation, it's a hedge against deflation, it's a store of wealth, it's a whatever against interest rates, it's all of these, it's the cure-all of things. So I would argue myself that those that bought gold up here at $1,800 would be very happy with their store of wealth down here at $1,000. It's none of those things. Gold is simply a commodity that is used in the jewelry industry and some industrials inside computers and those types of things, electronic products. It made a rounding base in November, December 2015-16. What concerns me about the gold chart in the short term, I've got no issue with the gold entering into a new trend. It probably will higher. At the moment we have what's called a 5-wave pattern in the weekly price of gold. Out of this low we had a very smooth move up here to the highs just here in March this year. A pullback, not unusual. into the low here in end of March, number 2 here. We then had a rally out to number 3, which took out the previous high. This is good. The difficulty here is that the pullback broke the previous low into here, so we have essentially what's called a widening range. Our first move into our high, our second move into here, our third move up to here, our fourth move down to here, and currently the fifth move took us way out here to 1374. This pattern in itself is described as a 5-wave reversal or horn pattern. This week we've seen potentially the first stage of that. If this follows through in here, we get a closing price below the previous week's low at around the low of the previous week was 1335.70. We stand a chance that gold may correct itself back to this high of the third wave here around about $1,300, which is also the midpoint of this large range. Very real potential will see gold come back to that level. Any further weakness in there will simply see this $1,200 level tested again. So in our daily note that goes out every day for the last week, I've been suggesting that you would dance close to the door with your gold stocks in the coming weeks. Now what we would like to see in this, of course, is a higher low set somewhere in here and the trend resume, quite possible. The rounding base here does suggest that the low is in gold and it just needs to sort itself out going forward. It is subject to fear and greed, profit and loss, like any other commodity, any other equity, any other commodity, any other currency in the world, and it will suffer that going along as it trends along the way as buyers and sellers come and leave. So in summing up, if I come back to my presentation, hopefully here, in summing up, I would like to thank you for coming out tonight. It's always a pleasure to do these presentations. Inside your go-to webinar box on your screen, there's a handout there. You've got a little handout area. There's a PDF file in there. It is essentially this offer that we have, an offer if you'd like to become an FP client. You may read in Investment Trends research that came out yesterday or today that FP Markets now is the most highly regarded company as far as trader education. Over the last 12 months, we basically blitzed everyone else in that area. It's something that I have a great interest in for the clients. If you'd like to come on board, there's an offer there. It's in a PDF file in your go-to box. Outside of that, if you'd like to register for the Monday webinar, we conduct a 30-minute webinar on just a bit of a summary of where we think the markets are going in the coming week and why. It starts at 9:30 on Monday morning. You go to the FP Markets website and simply register. There's a registration link on the front page of that. It's no obligation. It's free and no obligation. And also the morning note that goes out every day, it's generally out the door by 9 o'clock in the morning, and you can register for that. It's free and no obligation. So thank you everyone for coming out. I think in summary of what I've presented to you, I think we can break this up into two groups. There is a little issue in Europe which may turn into something and it may not. And we need to essentially watch what Draghi does in that area. Outside of that, there is GDP growth around the world. There is a rally in the commodities markets, and there is a tremendous amount of opportunity for you in these markets. So I look forward to good trading, and thank you so much again for coming out.